What is a mutual fund? I'm not answering it. It's a dead horse that's been beaten. How much money do I need to start investing? ChatGPT, many brokers allow you to start with as little as $1 to $100. It's not how much you need. So I think what they're getting at is how much money do I need to start investing? It's not like you need 10 grand or 5 grand or $1,000. It's like how much you show up with every single like paycheck. That's what matters the most. It's more about cash flow. And I'm going to get to cash flow right after I take a short break. I'll be right back. 2 seconds. And we're back. I looked at the video as well. It looked a little dark, so I opened that window. Hope we get a little light. Cash flow. So on a paycheck, say you check your online portal, you see your pay stub. A lot of times at the top, it says like net pay. Net pay. And we'll say it's, I don't know, $4,300. Underneath that is normally like a box, and it might say gross pay or total pay or just pay. So pay, and let's say we make $5,000 a month. We make $60,000 a year. Underneath that, it might say insurance. It might say, what other deductions would you have? Income tax, income withholding. And we'll just stop there for now. All right. We're not going to go into 401k withholding because we're going to go into this example of just starting investing. All right. So net pay is your pay minus like your health insurance and your income tax withholding from your employer. So we'll say insurance is $400 maybe. Minus that out. And then income withholding, we'll say that's another $300 that they withhold from your paycheck, making your net pay $4,300. Okay, so in this example, this is a pay stub. All right. You might see that at the top because employers really just want you to know your net pay because that's what's going to hit your bank account. When you get paid, you'll see $4,300. It's been added to your bank. All right. Can I see through this piece of paper? I can. That helps. That hits your account. 43. If you look at your pay, though, you made $5,000. You made $5,000. Insurance, you paid $400 through your company's health insurance, let's say. And then income withholdings, you paid $300. So you get this $4,300. Your cash flow is that $4,300 minus what you live on. And here's a strong. I'm not going to give recommendations, but this is what I would do. All right. Let's say that I've matched out my 401k and I can no longer get a match and I want to go into a Roth IRA. The first thing I'm going to do is I'm going to take what I'm paid, the $4,300. And I'm going to multiply it. So on my calculator, I type in 4,300. Whoop, that's not 100. I type in $4,300. 4,300. And then I'm going to multiply by 0.2, which is 20%. 20%. I'm going to take 20% of my pay, which is $860. $860. All right. And in this example, we're getting paid once a month, not bi-weekly, just this is a monthly pay. So my net pay is 43. Net pay, 43. Roth IRA is $800. $860 from 4,300 minus $860 in my Roth IRA is $3,440. This is going to be for living expenses. So when I talk about cash flow, this is what I'm talking about. Open this up so I can see as well. I get this net pay from this pay stub. I do it backwards. Most people get paid, they pay to live, they pay for their car, they pay for their fast food, they pay for their gas, they pay for their energy drinks, they pay for Walmart items, they pay their rent, and whatever's left over, they'll invest. I pay myself first. I pay my retirement fund first, my Roth IRA. So I'm going to put $860 into that Roth IRA that we already talked about. Living expense, $3,440. That's what I'm left with for the whole month to pay my rent, to pay for my car's gas and insurance, to pay for my groceries. That's what I'm living off of. So I don't think it's a question of how much, where'd that question go? How much money do I need to start investing? It's more about how much can you consistently show up with and invest in. And I'm going to give one more example of this because the stock market goes up and down. It goes up and down like this over a 10-year period, 10 years. And we're going to call this the S&P 500. S&P 500, and we'll even go out on a limb and say ETF. So I've gone to Vanguard, I've bought their S&P 500 ETF, and this is the past 10-year performance, up and down, up and down, up and down. One thing to avoid, if this is what someone was asking of how much money do I need to start investing, expecting an answer of like 10,000 to invest that day, I would not do that. I'm not going to tell other people what to do. I would not do that because you run the odds, you run a chance of putting $10,000 in at the top and losing a lot of value, maybe panic selling, or at least having to wait with a lot of anxiety for it to go back up. Going back to my cup, this is my S&P 500 for $1. We'll even call it $860. This is my monthly investment. I've bought $860 worth of the S&P 500. Excuse me. If I put this in at the top and it falls to half its worth, $430, I think, I don't lose any money. I no longer have money. I think people panic because they feel like they're actually losing money and they're not. I still have every single stock in this cup. I still own it. All right. I no longer have money. I can't lose money unless I sell this and take less money for it than what I paid for it. So if I buy it high and it gets cut in half, I personally would just want to hold it and wait for it to go back up. Also, I might try to invest more and buy more cups of stock for this low price, because it should, over time, go back up. This is called dollar cost averaging. This is a prime example of what dollar cost averaging can look like. If I show up every month or every paycheck and I put in that money, then I will buy at the absolute low. I will buy on the way up. I will buy on the way back down. I'll buy the bottoms again. I'll buy the tops. I will buy at every little point in time, every paycheck. Every little hash on here is a paycheck where I went to Roth IRA to Vanguard and bought that S&P 500 as an example. And this is called dollar cost averaging. Dollar cost averaging. Put this in a box so you can see it well. Dollar cost averaging, where I show up every paycheck and I put in that $860 into the S&P 500. And the average will be between the highs and the lows. It'll be that solid black line. We avoid putting a big lump sum like 10 grand in at a peak and watching it crash and waiting for it to go back up. Instead, we'll invest over time, should already have an emergency fund established, should be out of bad high interest debt by then, and we're showing up every month putting money in after we've already gotten our 401k match from our employer, the 100% gain same day contribution match. We're doing this. And this is where that would go as well. Our 401k, let's say like I had a 401k from an employer and they offered me the match. I'm going to invest it in their version of the S&P 500 ETF, and I'm going to do it every paycheck. That's dollar cost averaging. So it's not one lump sum of money to answer the question. In my opinion, it's finding the cash flow to consistently put it in every paycheck.